Hi everybody, and welcome back to video number 8 in chapter 19. And when we left off, we were looking at exploring post-retirement benefits obligations in a little more depth. Here in number 1, the expected post-retirement benefit obligation, the EPBO, is the actuarial present value as of a particular date of all benefits a company expects to pay after retirement to employees and their dependents. Companies do not record the EPBO in financial statements, but they do use it in measuring periodic expense. In number 2, the accumulated post-retirement benefit obligation, the APBO, is the actuarial present value of future benefits attributed to employees' services rendered to a particular date. The APBO is equal to the EPBO for retirees and active employees fully eligible for benefits. Before the date an employee achieves full eligibility, the APBO is only a portion of the EPBO. Or stated another way, the difference between the APBO and the EPBO is the future service costs of active employees who are not yet fully eligible. I think it's illustrated nicely in this slide here. Okay, so components of net periodic post-retirement benefit costs. Here we have service cost. That's the portion of the EPBO attributed to employee service during the period. Interest cost, the increase in APBO attributed to the passage of time. Companies compute interest cost by applying the beginning of the year discount rate to the beginning of the year APBO, adjusted for benefit payments to be made during the period. The discount rate is based on the rates of return on high-quality fixed income investments that are currently available. The actual return on plan assets, that's the change in the fair value of the plan's assets adjusted for contributions and benefit payments made during the period. Because companies charge or credit the post-retirement expense for the gain or loss on plan assets, the difference between the actual and the expected return, this component is actually the expected return. Amortization of prior service costs, that's the amortization of the cost of the retroactive benefits resulting from plan amendments. The typical amortization period beginning at the date of the plan amendment is the remaining service periods through the full eligibility date. And finally, gains and losses. In general, changes on the APBO resulting from changes in assumptions or from experience different from that assumed. For funded plans, this component also includes the difference between actual return and the expected return on plan assets. Okay, we'll shift gears a little bit and go to contrasting accounting for pensions to accounting for other post-retirement benefits. And here are some illustrative accounting entries. The 2025 entries and worksheet. The use of a worksheet in accounting for post-retirement benefits plan assume that on January 1, 2025, Quest Company adopts a healthcare benefit plan. The following facts apply to the post-retirement benefits plan for the year 2025. 1. Plan assets at fair value on January 1, 2025 are 0. 2. Actual and expected returns on plan assets are 0. 3. Accumulated post-retirement benefit obligation, APBO, January 1, 2025 is 0. 4, service cost is $54,000. 5, no prior service costs exists. 6, interest cost on the APBO is 0. And 7, 7, funding contributions during the year are $38,000. And 8, benefit payments to employees for the plan are $28,000. And here's our worksheet showing these numbers. I'll let you read those on your own. But here's our annual post-retirement expense, cash, post-retirement asset liability, the APBO, and the plan assets. So on December 31, Quest's adjusting entry formally records the post-retirement expense in 2025 as follows. Here, it's going to debit post-retirement expense of $54,000 is shown here. It's going to credit cash for $38,000 shown here. And finally, it's going to show the post-retirement asset liability here for $16,000 credit. Okay, now here we'll show the funded status reported in the balance sheet. And we have the accumulated post-retirement benefit obligation, a credit entry of $26,000. But the plan assets at fair value, that's a debit entry of $10,000. So we have a post-retirement asset liability in this case of negative $16,000. Now, as we recognize gains and losses, again, we're going to use the corridor approach. Gains and losses represent changes in the APBO, or the value of plan assets. Gains and losses are recorded in other comprehensive income. So using the corridor approach, this approach amortizes the gains and losses in accumulated other comprehensive income as a component of post-retirement expense, if at the beginning of the period they exceed a corridor limit. And then number 2 are amortization methods. And here, the companies may use any systematic method of amortization, provided that 1, the amount is amortized in any period is equal to or greater than the minimum amount. Number 2, the company applies the method consistently. And 3, the company applies the method similarity of gains and losses. Okay, let's take a look at an illustration for Quest Company in 2026. We have annual return on planned assets, $600. Expected return on planned assets is $800. The discount rate is 8%. The increase in APBO due to change in actuarial assumptions is $60,000. Service cost is $26,000. Funding contributions during the year are $18,000. Benefit payments to employees during the year are $5,000. And finally, the average remaining service life to expected retirement is 25 years. So we create a post-retirement benefits worksheet. I won't go through these details again, but you should be familiar with that from the past slides. And now we're ready to do our journal entry to record our net periodic expense. So the post-retirement expense is $27,280. We'll find that here, as we have been in the past. We have the $60,000 other comprehensive income gain loss, $60,200, and we find that debit here, and then we have our cash of $18,000 credit here, and finally our post-retirement asset liability is $69,480, and we find that here. So our accumulated post-retirement benefit obligation is a credit of $109,080. The plan assets at fair value is only $23,600. So we have a post-retirement asset liability credit of $85,480, which we find here, here, and here. All right. Amortization of the net gain or loss in 2027. Quest has a beginning balance in accumulated OCI related to losses of $60,200. Therefore, they must apply the corridor test for amortization of the balance for 2027. The accumulated OCI at the beginning of the year is the $60,200. Then we're going to take the 10% of the greater of the APBO, or the market-related value of the plan assets, and we do that by taking $109,080 times 10%, which gives us a negative $10,908. So our amortizable amount is $49,292. The average remaining service to expected retirement is 25 years. Therefore, our 2027 amortization of loss will be that $49,292 divided by 25 years, or $1,972. And here Tootsie Rolls notes to financial statements. They say the company maintains post-retirement health care, etc., etc. I'll let you read that on your own. And you can see they had a prior service credit here. And now we have a net actuarial gain here. And the net amount recognized in accumulated other comprehensive loss here. Okay. So, if we reconcile the OPEB liability, the changes in accumulated post-retirement benefit obligation at December 2020 and 2019 consist of the following. So here we have our benefit obligation at the beginning of the year, our service cost, our interest cost, our actuarial gain or loss, our benefits paid, and our benefit obligation at the end of the year. Okay. Now, the net periodic post-retirement benefit cost included in the following components. So now we're going to take the service cost benefits attributed to service during the period, and here they are. We'll take the interest cost on the accumulated post-retirement benefit obligation, and here they are. We have a net amortization as shown here, and finally, the sum of those are going to give us the net periodic post-retirement benefit cost, or income if it's bracketed, as shown here. And the company estimates the future benefit payments will be $544, $564, $590, $614, and $634 in years 2021 through 2025, respectively, and a total of $3,417 in 2026 through 2030. That looks like a good place to end the video, and when we return, we will continue on with comparing